Hi, I'm Sam Slater from FundCalibre, and today I've been joined by Nick Martin, manager of Polar Capital Global Insurance Fund. Hi, Nick.
Hi, how you doing?
So, from having events cancelled to holidays cancelled and obviously a much higher unemployment rate, the pandemic must have had an impact on the insurance industry, no?
Yeah, I mean, the property casualty non-life insurance industry is very used to dealing with catastrophe type of events. That's they're there to help individuals and communities in the most difficult times, and clearly we're in one of those right now. I think if you look at a pandemic and how that might differ from the sort of natural catastrophe types of events, it is a live, ongoing catastrophe. So that's not really restricted by time in the way that a hurricane and an earthquake might be, and that therefore increases the potential amount of outcomes that we have from that kind of event. But because pandemics are not constrained by geography and not constrained by time, it does make them very hard to insure, because from an insurance company's point of view, you don't want to be taking on open-ended and potentially unlimited exposure in your underwriting. So it does mean that a large part of the insurance market does exclude viruses and communicable diseases from their policy language. But as you say, of course, there are going to be insurance effects. Event cancellation is one of the obvious ones. We've seen the Olympics postponed, Wimbledon cancelled, etc. Obviously, travel insurance gets affected. With higher unemployment, mortgage insurance comes into play, and there's also been a lot of coverage in the news around business interruption claims, particularly here in the UK. Affirmative coverage is bought for business interruption, and that will pay out certainly, but there is more of a question mark when it comes to routine commercial property policies, because you do need a physical damage to your property in order to have a valid claim. And in some parts of the world, you do have particular policy exclusions around viruses and communicable diseases, particularly in America, where they've had that standardized language for almost 20 years post SARS. So I think putting it all together, I think the pandemic will probably lead to, in our base cases, about $60 to $70 billion worth of insured losses. And to put that into context, the biggest single loss before this was Hurricane Katrina, around $50 billion. So quite sizable. But I think it's important to take the perspective that that $60 to $70 billion is equivalent to about 2% of the global property casualty capital. So very manageable in that. And we would typically expect $80 to $90 billion of natural catastrophes in any one year. So add in the pandemic to that, gets you to a sort of 150 billion, which is in line with what we saw in 2017. And in that year, the industry put up pretty decent results in that year, and I think we'll see the same again. So I think for the industry, it's an earnings event and not a capital event.
And you've spoken about the improving underwriting market over the last year or two. Could you perhaps explain very briefly what the underwriting market is and how it works with insurance companies, and perhaps how the pandemic has affected that area of the market and your outlook for companies?
Yeah, I mean, pricing in underwriting does reflect the perception of an insurance company of the risk. There is also a function of the demand and supply of capital into the market at any one time, like any other sort of balance sheet sort of based industry. And what we've really had over the past year or two is an improving pricing environment, particularly in primary commercial insurance. That's been driven by a number of factors, and we've had Mother Nature come back to sort of more normal levels of activity since 2017, after a very benign period for catastrophe events. We've had a number of the major market participants reduce their risk appetite because they've had underwriting profitability that they haven't been happy with. And we've also had, of course, the lower, or the ongoing impact of the low investment return environment. I think from a non-life insurance point of view, that's very manageable. We can change underwriting prices every year because it's annual contracts to basically reflect to those investment returns, and therefore you can compensate by those low returns from much better underwriting profits. So we've certainly seen that come through. Just to give you a sort of sense of where we've been, Marsh is one of the global brokers, puts out a widely followed index, and their rate changes for primary insurance was about 3% in the first quarter of 2019, and rising to 14% in the first quarter of this year. And that really is the impact of the current pandemic. I think once we've seen what's happened in the last couple of months, and then the big step change in the underwriting markets has really been on the reinsurance side. Pricing there was a bit of a laggard compared to other parts of the market, but that's really had a step change in recent weeks, and we've entered, we think, a traditional hard reinsurance market, and we've had some early evidence of that. The 1st of June is when the US catastrophe and Florida risks get renewed ahead of hurricane season. And I think, if you go back a few weeks, the expectation was for a rise of 10 to 20%. We've had more like 25 to 45% rises. So I think if you look at underwriting overall, I think we're in the best market we've had for at least a decade. And one of our companies the other day was explaining to us that the current environment is the sort of thing underwriters only see sort of 2 or 3 times in their careers.
Do you think there'll be any additional long-term changes or new trends emerging on the back of this crisis? An emerging markets equity fund manager we spoke to recently, for example, said he thought it might accelerate the adoption of insurance in emerging markets. Do you agree with that?
Yeah, I certainly would agree with that. I think whenever you see the kind of events we've all experienced in recent months, there's a greater appreciation for risk and overall. And I think there's a greater appreciation for risk for that particular event. So, in this case, a pandemic. I think one of the challenges the insurance industry has, as we've touched on already, is that it's quite difficult to insure pandemic risk because viruses don't respect borders. They're unconstrained by time, and therefore the pricing of that risk remains difficult. But it doesn't mean to say there's not a solution out there, and we've seen something similar to this before, with global terrorism risk. Back in 9/11, those were obviously horrific events that showed that catastrophes could be made by man as well as caused by Mother Nature, and the insurance industry didn't have the balance sheet to take on some of those potentially huge exposures from global terrorism risk. So what happened was that there was a mechanism set up called TRIA, where the insurance industry would take on a manageable part of that risk and get paid an appropriate premium to do so, and then the government would be a backstop beyond that initial exposure that the industry takes. And I would expect we'll see something similar to that coming in, and understand there's a few things in the works already and around all of that.
And finally, you said recently that the insurance industry is helping to tackle climate change challenges, and insurers are playing an increasing role in furthering the United Nations Sustainable Development Goals. Could you perhaps tell us a bit more about this, please?
Yeah, I think the insurance industry has a critical role to play in helping society at large manage climate change, which is obviously a huge priority and of importance to everyone out there. I think if you think about, insurance companies exist really to take the volatility that you and I and companies and governments do not want to have on their own balance sheets, and certainly climate change is increasing those risks. I think it's been important that we've had almost a societal pressure to recognise better those climate risks that everybody has. We see initiatives like the TCFD, the Task Force for Climate-Related Financial Disclosures, that was established in 2015 by Mark Carney and Michael Bloomberg at the behest of the G20, encouraging companies to really disclose those risks. And of course, when those disclosures are made, then the thing that stakeholders want to know is are those companies managing those risks appropriately? And insurance is a very good mechanism, to do that. You mentioned the United Nations Sustainable Development Goals. That's a hugely important framework, I think, in terms of establishing sustainability and resilience into communities all around the world. It's also very useful, I think, for investors to use that as a framework to evaluate different industries when it comes to things like ESG. And I think if you look at insurance in the context of those 17 Sustainable Development Goals, it touches virtually every one of them. There's some obvious ones, climate action. We talked about hurricanes and earthquakes and the like, and the impact of severe weather obviously has on communities. There's the zero hunger goal, and you think about the important role of crop insurance, particularly in emerging and developing communities where lots of production of food is local and farmers are at risk by severe drought or hail or something, and they need to be sure of having the right capital to invest in their production in the following years. So insurance is very important there. And also things like just the almost more routine ones, decent work and economic growth is another one of the goals. And ships don't sail, planes don't fly, your Amazon package doesn't turn up the next day if insurance is not in place. And it's essentially, we think, that the oil that greases the wheels of world trade. And I think as long as risk remains in the world, and I think it's fair to say that risk is always going up over time, the insurance industry has a very bright future ahead of it.
That's great. Thank you very much. If you'd like to find out more about the Polar Capital Global Insurance Fund, please go to FundCalibre.com.